Nvidia already hitting a fresh record high this week ahead of its earnings, while the VIX closed at its lowest level in 5 years. So volatility is low, major indices hovering near record highs. Could Nvidia be the fuel for the next wave of optimism in the market? Here to break it down for us, we have Venu Krishna. He is Barclays head of U.S. equity strategy, and he joins us here in studio. It's great to speak with you. Thank you for coming in.
Thank you for having me.
Talk to me about the signal that Nvidia's earnings could have for the rest of the market and what folks should be looking at within the earnings and just more broadly as a signal for where the market might be heading.
Listen, Nvidia's earnings are very important because in general, if you look at what has been critical to S&P's rise, it's been big tech, and Nvidia is a critical component, probably the most important component of that subgroup of just 6 stocks. And if you look at even, for example, what the market is pricing in the options market, for example, it's unbelievable that the 3 most things which the market cares about right now is the CPI print, followed by Nvidia earnings, and then the non-farm payrolls over the next month. So that just tells you how important Nvidia also is in the big scheme of things, right? But that said, I think at least in the options market, it's pricing less of an upside for Nvidia in this earnings compared to the last earnings. But remember, this is a 2.3 trillion plus stock. Yeah.
What does that then tell us just about future earnings growth and what exactly that is going to look like? If we're starting to see it slow just a little bit, obviously Nvidia has certainly been an outlier in terms of the tremendous growth, astronomical growth that they had seen over the last 4 quarters. But what does that tell us? Just maybe, will we start to see more of this return to normalization? What does that ultimately then mean for the broader market as well?
So I would say to some extent, you're already seeing that, right? Mm-hmm. If I look at big tech as a group and you look at the extent to which the earnings surprises have been happening in the last few quarters, they've been coming down. So if you go 2 quarters ago, it was almost 14+%. Then last quarter is about 8.5%. So now it's inching lower. That's not because they're not doing well. It's because a lot of the upside and optimism is getting baked into analysts' earnings estimates, right? So to your point, what it does mean that going forward, the ability of these drivers of the market to continue to surprise and raise gets more challenging, right? So we do think that going forward, it does get incrementally challenging, but it's also a fact that over the next probably, call it 2 to 4 quarters, the visibility is quite high, including for Nvidia. So when we talk to our fundamental analysts, they're fairly confident. Where it starts getting a little blurred is when you start going a year from now, what is the end state? That is still unknown because of the torrid pace at which it's been growing.
What would, that's really interesting to me. What is going to help us inform what our market is looking like a year from now the most? I know you talk through a couple of different things like CPI, Nvidia earnings, payrolls being big catalysts for the market.
Right.
Which of those is the biggest thing that you think will help us understand a year from today?
Yeah, I think one thing certainly is the CPI number, and I wouldn't just put it directly on CPI. Right now, the equity market's sensitivity to CPI prints is the most negative it's been in 25 years, right? So in other words, the market does care a lot. And I think one of the channels in which it's going to percolate into the equity market is through the rates market. So if the 10-year treasury curve starts moving the wrong direction, that is, it's come down recently, it starts going up. And especially once it starts getting closer to the 5% threshold, you can see the equity market getting a lot more antsy, right? So that's one. The other thing I think which is very important to the equity market is fundamentals actually are improving, right? That's what Q1 showed, which is a very, very healthy sign. But the expected broadening has been just about incremental. So I think what one would have liked to see is the broadening outside of tech, especially big tech, indeed happening, and is it gaining pace? So there's some very early green shoots of that, but I think a lot more needs to happen to get comfort around that level because we've been dragged up by big tech quite substantially thus far.
Going back to what you just said a minute ago, the action that we're seeing in the bond market, we are coming down just a bit, but if we were to go back to those 5% levels, I guess what readings in the inflation print would cause it? Would it need to come in much hotter than expected? Or even if we stay around the current level that we have been hovering around. We did see a bit of improvement here, but the elevated levels that we are still hovering around, is that going to be enough to really put some more fear back into the market when it comes to inflation?
So one of the interesting things on CPI readings is that in fact, the surprises have been coming down, right? And so that's good news. In other words, most of the inflation forecasters are broadly in line with expectations, right? So nothing is surprising us. So the surprise will come if it goes up a lot more. So it's debatable what the number is, but I would argue that a 1% threshold around expectations, that's a pretty wide one for inflation, can be thought of in some ways as being reasonable. If it goes above that, then the market is going to fall. If it goes below that, then probably there's more optimism that potentially rates can get cut, right? So I think that's what it is, because even though inflation, the big part of inflation battle in my mind has kind of been won, because remember core PCE, which is what the Fed cares about, has come down from around 5.6% at the peak to around now 2.8, 2.9% level. But if you look at the 4-month CPI, it is annualizing 4% right now, core PCE. So I think we are in an interesting situation where inflation is somewhat sticky, but I think for equity markets to work, inflation doesn't need to have come down quite sharply from here, because the market has handled it quite well thus far. But any risk of rates being increased or rates actually going up, rates increased with the Fed, is definitely a negative.
It's that last leg of the marathon that's always the hardest, right? Venu, thank you so much for joining us and coming in studio. We really appreciate it so much.
You're welcome.
That was Venu Krishna. He's Barclays head of U.S. equity strategy, joining us in studio.